Hey, Mike Pillow here, Century 21 Homestar and 21 Mike team. Thanks again for showing up today for my Tuesday real estate workshop webinar. Today we're going to talk about interest rates, mortgage interest rates. With the mortgage interest rates dropping last week, I thought this would be a good subject matter to cover today. So let's jump right into it. And let me share my screen and away we'll go. All right. Mortgage rates and real estate. Well, last Friday, the mortgage rate dropped down to 6.29%. That's the lowest that the mortgage rates have been since October. And it's the largest one-day drop since August of 2024. So, like I said, this must be the break that buyers have been waiting for. And, it's not just the break that the buyers have been waiting for, it's the break that the sellers have been waiting for as well. A lot of homes are sitting on the market because buyers have become a little more choosy with the interest rates being in the mid sevens. So, again, my name is Mike Pillow. I'm a realtor with Century 21 Homestar and the 21 Mike team. Come join me every week at 10 o'clock Tuesdays for the real estate workshop webinar. And make sure you hit my QR code there where you can meet Mike. It's just a short video introduction, tells you a little bit about me. And if you want to get that link sent to you for this workshop, just shoot me an email at mikepillow0707@outlook.com, or you can give me a call or shoot me a text at 740-504-6251. So back to the interest rates here. So what is an interest rate? What is a mortgage interest rate? Simply put, it's just the cost of money. It's the yearly price to borrow money, and it's expressed as a percentage. Your monthly payment is equal to the principal plus the interest. And in some cases, it's also going to include the taxes, insurance, PMI, and the lower the rate, the lower the monthly payment. So, how mortgage rates are determined. And it's a misconception, and most people think it's the Fed that sets the mortgage rate, and it's not. It's the market. The market sets the mortgage rate. Lenders sell mortgages to investors, or they package them into mortgage-backed securities or MBSs. Investors compare MBS yields to the safe benchmark, the 10-year Treasury bond. They demand a spread or extra yield for risk and prepayment uncertainty. Rate equals Treasury yield plus spread plus lender costs. The Fed influences directly through its policy rates, QE or QT, and liquidity moves, but it does not set the 30-year mortgage rates directly. And explaining what QE and QT is, QE is when the Fed will kind of motivate the economy by, well, let's just look it up. I had this up earlier. I am not real up to speed with it, so let's just see what old ChatGPT has to say about QE and QT. Understanding quantitative tightening, how the market Fed reduces the market. Quantitative tightening, QT, it involves monetary policies that contract the Federal Reserve's balance sheet to either selling treasuries or letting them mature. This process reduces liquidity in financial markets and is designed to control inflationary pressures and prevent an overheating of economy, effectively reducing as the opposite of quantitative easing. Quantitative easing, where the Fed adopts measures to expand its balance sheet. So it's just the way the Fed helps regulate the market. All right, let's move on here. Factors that push rates up or down. Well, of course, inflation expectations influences the market. Higher the inflation, higher the rates. Fed expectation, market prices and expected hikes or cuts. The 10-year Treasury yields, the biggest daily driver. MBS demand, pension funds, global investors, Fed QE programs, credit risk and loan size, borrow credit score, down payment, and the program that the creditor is or the borrower is going to choose. Housing, this comes down to the supply and demand. It's going to affect lender's appetite for risk. So how do mortgage rates affect your monthly payment? Well, like we said before, lower rates equal more quality buyers. More buyers qualify. It's going to lead to a stronger demand. It's going to lead to an upward price pressure. Higher rates equal fewer qualified buyers. That's going to lead to slower sales and a downward price pressure. Lock-in effect. Homeowners with low 2020 or 2021 rates, they often hold off on selling. It makes sense. I mean, if you're able to refinance or buy a home at a 2.53% interest rate, you may not be inclined to sell right now because you may not be able to get as much bang for your buck because of the cost of money. And in doing so, this reduces inventory and it keeps prices firm. And this is true in even the higher rate markets. Now here's a quick tour of a 30-year history of rates. If we look back to the 1980s, there were record highs of near 18%. This is where the Fed had to fight inflation. If you think of late 70s of the quote unquote great oil shortage, and where you could only purchase so many gallons of gas per day, and you would sit in long lines to buy gas. The inflation was just insane. And like I said, record highs of 18% to purchase a home. I think back to some of our parents buying homes in the late 70s and 80s, paying that kind of interest rate. It's insane. Then in the 1990s and the 2000s, we saw a gradual decline as inflation started to stabilize and markets started to mature. Then in 2008 through 2019, which we call the post-financial crisis, this led to the Fed QE that kept rates around 3 to 5%. Then in 2020 to 2021, the pandemic lows, we saw rates drop as low as 2.65%, which set historical records. So, think about the difference there. Many of us enjoyed a 2.65 or 3% cost on money, while our parents are paying 18% back in the 80s. It's just crazy to think about it. Then 2022 and 2023, the inflation surge plus Fed hikes, this led to rates peak above 7%. And we were all complaining about how high the interest rates were because we were getting spoiled, enjoying the record lows of 3%, 2.65%, that we thought 7% was just ridiculous. 7.5%. Are you crazy? I'm sure our parents were saying, yeah, we paid 18% in the 80s. Then 2024, 2025, as we saw inflation ease up a little bit, this led to rates that kind of fall back into the mid-6 range. In September, we're averaging 6.35, with last Friday, as we mentioned at the beginning of the show, as low as 6.29%. So, what's this all mean? Let's just look at some simple math here. A loan of $300,000 and a loan of $400,000. You can see how just a small spike in the mortgage rate percent, how it will increase your monthly payment. So your key takeaway here is a small rate drop, like a 6.5%, and it drops down to a 6.29% as it did Friday. You could save $41 a month on a $300,000 loan. Or on a $400,000 loan, you're going to be saving $55 a month. So what's this mean? Over 30 years, that's tens of thousands of dollars saved. Just less than 21% or 0.21% of a drop in the percentage. So there's 7 questions that you want to ask lenders when you're interviewing lenders before you buy a home and you get yourself pre-qualified. And we've covered this in other webinars. There's a huge difference between being pre-qualified and pre-approved. We're all pre-qualified. My dog is pre-qualified to buy a home. Being pre-qualified doesn't mean that you're in position to buy a home. It just means, yeah, you can be qualified. Everybody can be qualified to buy a home. Pre-approved means you've sat down with the lender, they've run your credit check, they have ran all your finances, and that pre-approval letter is saying, as a lending institution, we're willing to give you this loan up to X number of dollars so you can purchase a home. And most sellers won't even consider an offer unless you present a pre-approval letter. So again, know the difference between being pre-qualified and pre-approved. Pre-qualified really means nothing. You need that pre-approval letter. Think of it as you want to earn an A on your homework or on that test. A for approval. You want to be pre-approved. All right, 7 questions. Number 1, you want to ask that lender, or all the lenders that you're interviewing, what's the EP or the APR all in versus the quoted rate? The interest rate is just the cost of borrowing the money to buy the home. It's not including the fees involved with it. The APR, or annual percentage rate, includes the interest plus upfront fees, points, and certain closing costs. It's it's a better apples to apple comparison when you shop lenders. So your key takeaway is this: if two lenders both quote you a 6.29% interest rate, but one has an APR of 6.5% and the other has an APR of 6.42%, the second one at 6.42 is cheaper overall. Okay, lock in your mortgage rate. You want to ask, how long is my rate lock? How long is it good for? And do you offer a float down if rate fails? If rate falls. Rate locks are typically 30, 40, or 60 days. A longer lock gives you more protection if closing takes a little longer, but it also costs you a little more. And some lenders will offer a float down option. That's if the rates drop during your lock period, you can adjust down once. And this usually is done with a small fee. So your key takeaway here is always ask about the lock length and float down in writing. And what are the closing costs and lender credits or points involved? Well, the closing costs typically run anywhere from 2 to 5% of the loan amount. This will include things like the lender fees, title, escrow, appraisal, etc. Your points, you can expect to pay extra to buy down your rate. That's what your points are. You pay extra at the beginning of your loan period to try to drive your interest rate down. Credits, the lender may offer a higher rate in exchange for giving you money towards closing costs. Think of it like this: you can pay more now for savings later, or pay less now with a slightly higher monthly payment. That's your difference between points and credits. Credit score. How does my credit score, or how do my credit score, my down payment, and my debt to income ratio affect my rate? Well, credit score basically is the higher the score, the lower the rates. A 760 plus credit score is going to get you the best pricing and interest rates. Down payment. If you have a larger down payment, you're going to get a lower interest rate from the lender. And your debt to income ratio. If your monthly debts take up too much of your income, lenders may charge a higher rate or deny the loan altogether. What you need to look at this is, what have you done with your money, your credit score, your savings, where you can put down a larger down payment, and you've managed your debt to income ratio where you can easily pay your bills. What have you done that you can present to a lender to reduce their risk into giving you a loan? Lower the risk, lower the interest rate. So a key takeaway here is a small bump in your credit score or extra down payment can sometimes save you tens of thousands of dollars over a life of a loan. So, especially for some of the younger folks that are projecting out to maybe buy a home in 5, 6 years, these are 3 areas that you really want to focus on and get control over before you go to a lender and ask them for a loan. It's going to save you so much money. Okay, you want to ask, are there any prepayment penalties? On most standard fixed loans today, there are no prepayment penalties. Some specialty loans, non-QM investment property loans or jumbos, they may have them. You just want to make sure you always confirm with your lender, if I refinance or pay off my loan early, will you be charging me a penalty? Number 6, you want to discuss with these lenders the different types of loans that you qualify for and which loan program fits your goals best, whether it's a FHA, a VA, conventional, or jumbo. And to break this down, a conventional loan is actually your best route to go if you have a good credit score and you can submit a minimum of a 5% down payment. It's going to get you, it's your best loan program. An FHA loan, it's easier to qualify. You have a lower down payment, often 3.5%, but has upfront and monthly mortgage insurance. So that's going to make your monthly payment higher. VA loan, you can get a VA loan with no down payment. You're paying no PMI. However, it's only eligible for veterans and active military. The jumbo loan, over the conforming limit of $766,550 in 2025, it requires a stricter credit income ratio there. So, all in all, you just sit down with your lender. He's the professional or she's the professional, and they can match the program to your credit, your income, and how long you plan to keep the home. And lastly, number 7 question you want to ask your lender: show me 2 scenarios, the lowest rate with points versus the higher rate with no points, and where's the break-even point? So what I'm saying here is, with points, you pay more up front to lower your interest rate. Without points, you pay nothing extra up front, but the rate is slightly higher. And the break-even point is how long it takes you to pay back at a lower payment that upfront cost, to where now you're breaking even. Example of what I'm talking about: you buy 1 point. 1 point equals $300,000 up front. It saves you $60 a month. The break-even point is at 50 months, just over 4 years. So if your plan is to stay longer than that, points are well worth it. If you're not, just skip the points. You want to get to that break-even point and go beyond. So the longer you intend to stay in the home, the more sense it makes it to buy the points. Okay, some practical tips. Be sure to shop at least 3, if not more, lenders. And you want to go to them with the same assumptions. The same loan size, same term, same points. That way you're comparing apples to apples and oranges to oranges, and you're getting the best terms possible that you can find. Lock when timing matches your purchase. Short locks equal cheaper, but they are riskier. And remember, points only make sense if you stay in the home long enough to break even. And refinance your home if your monthly savings times the months left are greater than the closing cost. Let me say that again. Refinance your home if your monthly savings after refinancing times the months left you have on your loan are greater than the closing costs that you're about to pay to refinance. So a good rule of thumb here is a 0.75 to 1% drop is usually worth it. So, and again, get with the professional. They're going to direct you down your best path. Okay, closing. What's this mean for you? Rates dropped into the mid sixes, and that's a real affordability boost. You know, we were just paying 7 to 7.5%. It dropped 1%, a little over 1%, almost 1%, and 1.21%. Remember, we were talking about refinancing. If it drops anywhere between 0.75 to 1%, that's time to make a move. Well, the rates just dropped 1.21% last Friday. That's a big shift on a 30-year mortgage. That's tens of thousands of dollars that you're going to save. Remember when we were talking about the $300,000 and $400,000 loans, how just, 0.15% of a interest rate could save you, several dollars a month on your monthly payment, and over a period of time, tens of thousands. So this 1.21 drop is pretty big. This means that buyers can now afford more house with a lower payment. This means that sellers are going to have more buyers out there who can get pre-approved and qualify to buy more home for less. Now is a window of opportunity that you want to strike now before the rates shift again. Because even though it makes a big difference with a shift when the rates drop, the same is true when the rates rise just a few percent or a fraction of a percent. It makes a huge difference. With this huge drop, 1.21% drop, now is the time to make a move. Now is the time to give your local realtor, say like me, Mike Pillow, out in Apple Valley, Knox County, Central Ohio. It's time to give somebody like me a call and say, hey, Mike, it's time for me to buy. Mike, it's time for me to sell. Because I watched your webinar and you educated me on interest rates. All right. So thank you so much for being here with me today. And I want to give you an opportunity to get a free copy of my digital ebook, The Homeowner's Playbook. This is the seller's and buyer's guide to real estate. It takes you from for sale to sold. And this helps both the buyer and the seller. And to get a free copy of this ebook is simple. All you have to do is shoot me an email. See the email on the screen, mikepillow0707@outlook.com. And in your email, just include your name, your phone number, and when you might be making a move. You can also give me a call or shoot me a text message at 740-504-6251, and I will be happy to send you your free copy of my digital ebook. And like we do every week, we always end our programs with a special message from the 21 Mike team and our K9 division. Today we have Bentley and Finley and Amos in the background in the truck there. He's looking at the geese out the other window. And their message for you today is the same as always. You're not the only one looking for a home. Please go visit your local dog shelter and adopt your next new best friend. So until next week, we're going to have something really special next week I want to share with you. I've already started planning it, and I look forward to having you join me next week, Tuesday at 10 o'clock. Until then, you have a nice day.